So yeah, welcome to the BullRush Live, David. We're really happy to have you on today.
Guys, thanks for having me on.
Nice. I'm curious, how long did it take you to become a profitable trader when you started?
Oh, years. You go through periods where you think you're profitable, but then the actual extraction over a longer period of time is just insane. And I think there was a big shift from maybe 2017 right up to 2020, where before then FX was really, really good to trade. Um, After then, I think 2018 it might have had a little bit of an uptick in success, but the fact is that that market in FX was just not volatile enough for such a long time. And as interest rates hit zero, and especially over the pandemic and things like that, it just became a nonsense asset class to trade. So over the last couple of years, I've really realigned myself to stocks because it makes sense to. Everyone's selling volatility, which leads to an upward drift in the S&P. Of course, US growth helps heavily as well. So really, I'm equities focused, and probably, that initial shift was maybe 3-4 years to saying, okay, I know I can extract X out of the market over certain periods. I know when I'm going to have a bad period, know when I'm going to have a good period. So, push on the pedal basically during those good periods, take it off during the bad periods. But to recognize that, it really takes a relatively long time. It was probably 3, 4, maybe even 5 years till I was like, I know what I'm doing, basically.
Yeah, I mean, it sounds like one of the biggest takeaways I just took from there is knowing how to pivot. I know that's basically what ruined my trading career. Was I could tell I traded oil and gold primarily, and silver, those three products. And as soon as MF Global went out of business, I just saw all the volatility and liquidity drop, and the market just started like skipping around. It wouldn't actually trade because there was no real person in there. It was just getting spread and all the algos, and I could not pivot. I literally was trying to pivot and trying to find other products. I'm like, yeah, this isn't for me. I'm going to go switch sides of the industry. But it sounds like for you, you did a really good job pivoting, which seems important in when you're trading to be able to jump around and understand where there's opportunity or where there's not opportunity, and shut it down if there's not opportunity.
Yeah, I think as well, it's an interesting shift going from a property outside of the US. There's traditionally been a lot of leverage involved in the product when it was, I'm sure you can remember it, the 500 to 1 days with European brokers, to an asset class which, in equities, you obviously can get leverage, and that leverage tends to come via options, right? But really, if you're buying cash equities, there's no leverage. So I feel like the leverage trading game, futures trading game, anything based on margin is very much a younger man's game anyway, which suits me now that I've got a 4-year-old, and I've got a lot more bills and responsibilities to look after. So I can't be one day up here really, really sky high, and then the next day I'm like, fuck, what's going on? Which
Right.
I think happens a lot with leverage, unfortunately. And I think it's definitely the undoing of many traders. I think being unleveraged is nice and boring. But a lot of people still want, because they don't have massive account sizes to make up a meaningful return. They forget about the compounding part of things, and equities can really compound, especially if you just pro US and just go with the flow. Like, it really, really does work.
Speaking of equities, I know we're in earning seasons right now. Are there any particular earnings that you're excited about or looking forward to?
I think all of the banks, JP just released their earnings, and I think they made 12 billion in the last quarter. Insane profit,
Yeah, that's
like not
crazy.
revenue profit. BNY, I think, just reported, or they're set to report. I think all of the banks is just crazy, because what it's really identifying with the banks, it's identifying more of a broader macro theme here, specifically to do with the United States and the extent of growth since the pandemic, which then gives you a really clear mind as to where to put your money. Because really, what the way in which banks make money is net interest margin, right? Interest rates are
Mhm.
sky high at 5%, compared to the last 15 years. And most people were betting on this actually creating a kind of growth constrained environment. The fact that it didn't constrain growth at all and hasn't constrained growth, take the last NFP print, for example, it beat expectations. This just tells me that there is no other alternative as to keep your money in US equities. You know, the large cap US equities, I don't think you can go wrong. And so this is why I'm really focused on the banks, because it's just showing that macro picture of the US. And we've already had a soft landing. People keep debating, are we going to have a soft or hard landing? We've had a soft landing already. You know, inflation's back down, growth is perfect. Like, stop debating that. We're in a perfect situation. We're probably going to hit 6K on the S&P 500 by maybe mid-November, I'd say, if we're going at the pace we're going. We've already had a soft landing. So the banks for me are a fantastic identifier of economic activity. And the fact that they're reporting earnings so strongly is really, really key.
Do you think that the U.S. elections could disrupt that or help move that in to fruition? How do you sort of see the U.S. elections playing into the U.S. stock market?
Yeah, well, I think, if we go back to the start of August, where we saw volatility get bid, I think we could see a situation like that. But the thing is that people came in right away and sold that volatility. Like, it didn't stick around. It traded up to 62 on the VIX, and was there just for a day. Usually, if you were worried about something, it would have stayed there for a couple of days, and you would have seen the market drift a little bit lower, but it didn't. The bid was just insane. So I think it traded down and then just got bid up right away. Vol sold off. I think that same situation could occur with the election. But the thing is that we're still in a good growth environment. I know people hate Joe Biden. I don't think he's a very good president. But if you're an equities trader or a trader in general, you should be thanking Joe Biden for the last 4 years, independent of his politics or whatever, because he's just let 500 keep going up. He hate that on some sides, but it's a full print money. Fantastic. You don't really have to care, but you can wind people up and say, well, why do you hate Joe Biden? Have you not just been along the S&P 500 for so long? So look, I don't think the presidential election is going to really affect US growth at all. It's not going to affect corporate earnings. It's all a bit of a show. And I think it's a bit of a football. Whenever you see the US election compared to the UK election, it's literally like a Hollywood movie in comparison. So I think it's just a little bit of a GDP boost, quite frankly. It might just give 5 basis points on the GDP number because of all of the performance related to it.
There's billions of dollars here in the United States that are thrown into elections. And so, from that perspective, it definitely boosts the economy anytime there's the presidential election. Because you have
great time.
You literally have everything. You have everybody printing the stickers. You have all the ad revenue that's driving it. Mm-hmm. You have all the lobbyists that are going and spending money. You have everybody, or a lot of people heavily invested, especially corporate America, because it can directly impact what they do over the next 4 years, whether they're hiring or spending money, or even pulling back a little bit.
And from what we can see with the,
imagine if Kamala does get in and now she walks back her capital gains tax, the one on 100 million plus of earnings, or whatever the tax was, wealth tax. Imagine if that gets walked back, the market's going to fly. And that's what I think is going to happen. They float these balloons, they walk them back, and it just actually, it kind of anchors people to a certain way of thinking. And then when they don't do that, they're like, oh, okay, now things are better. Mm-hmm. So that's the way that I'm seeing it. It could be a really, really sort of contrarian view on if you are an equities trader and you're battling with, or a trader in general, if you're battling with maybe Kamala getting into power, she does remove that, it could be in your favor. It's like hedging yourself when you're betting on your football team, or when you support you bet on the other team just to make sure that you're happy if one loses and the other wins.
Yeah,
that's good advice. Yeah. Speaking of hedging, do you use any hedging strategies and options when you're trading?
No, unless you're trading a £500 million or dollar portfolio, and it's really large. And if you're actually going to sell some, then it's going to cause a footprint and all of this, or it's more cost effective to buy puts rather than sell your. There's no point as a retail trader really hedging. I think hedges are for gardens, is what I say, and I think people start to overcomplicate things and really drive their costs up if they start hedging and doing all these complex strategies. So I don't really do it. At the end of the day, I think a lot of option structures are actually just a broker's dream, because if you're trading a box spread, that's 8 legs in and out, right? That is, you're paying 8 times of commission to a broker. Not that anyone's going to trade box spreads, but it's just an example, So I think there's a lot of encouragement for people to trade different option structures and hedge and stuff like that. But really, for a retail trader, you don't really need to. I mean, if you're taking outright positions, then sure, options are a fantastic play to do that. But to hedge, just sell it.
That's interesting, because I know in the FX world, in the United States, you can't hedge FX contracts. But internationally you can, and I know it's a really popular strategy. For those that don't know, I've worked at FX brokerage firms in Australia for a number of years before doing this, and it was, I would say, at least half the traders deployed some sort of hedging strategy.
I don't know why though.
As a broker, like you said, we love it because we just kept collecting the spread on both sides.
Yeah.
It's great.
And how we did it too, you still got charged swaps both sides, and so like it benefited us for sure.
Yeah, don't know why they do it ever,
but it's really popular.
It's the mindset. Yeah, it's the mindset of retail, and I think there's a lot of advice that feeds down from institutions and hedge funds and buy side into the kind of retail psyche, which applies in some contexts, but then doesn't apply a lot in other contexts. Things like, for example, edge. Okay, I think edge is really, really spoken about. Edge, and to some extent alpha, because I think that these days there's a desire to seek edge from institutions in very, very small time frames. They're employing quants that are trying to reduce latency by 1/10,000th of a second, and they're paying them 500 grand for that. That is a specific edge, but I feel like edge is very much overstated in the retail world because you're trading less capital. There's a much wider berth that you can give yourself when you're trading less capital. You're not also forced to do a lot of the stuff that institutions have to do, such as watch their footprint, ensure that their trading costs are really, really tight, because it eats into such a large percentage of their capital, perhaps. And so I think in some contexts, retail trading, if you know what you're doing and what to look for, is actually, in some ways, as long as your account size isn't too small, easier than trading certain strategies at a larger institution. So I think in some extents, the retail mind sort of overcomplicates things for no reason. And yeah, in some ways things can be harder, especially if you've got to juggle a job and trading 100%. But, generally, I think there's some advice that is brought down that is just a little bit wrong and used in the wrong context for the wrong counterparty / agent / whatever you want to call participant in the market.
What, for retail traders out there, what do you think is one of the bigger mistakes that most retail traders do?
I'm probably going to get a lot of stick for this, but focusing on price action and not enough on thinking sort of statistically about what the market's doing at what points. And what I mean by that is, if you're looking at a ranging market, you're really looking at a bit of a sort of normal distribution, right? If you were to put a bell curve up against the side. So maybe rather than look for that breakout all the time where you're focused on price action, just do the normal thing and look at where the market's probably going to return to an average. There's not enough probabilistic thinking, I think. And that is one thing that comes in. And the use of statistics incorrectly. I see people back testing stuff and say, my stats say this, that, and the other. Right, but that's not really what you need to be doing. You need to be running sort of Monte Carlo simulations. You have to be doing thinking about things in a completely different way if you want to use stats in that way. I think a lot of people get really bogged down in the back test and forget actually what a back test is meant to do and represent. It's meant to represent the initial very basis of whether you should even go for a forward test on that strategy. So better statistical thinking, I think, in context of what the market is doing, and more forward testing is really what retail traders need to do.
Okay, interesting. And I heard you mention price action. I know there's a really popular guy out there that does the ICT stuff, and we have a ton of traders in our Discord that always talk about ICT. I would take it you're not necessarily a fan of that strategy more.
So Michael has been around for, I think since the first time that I spoke with you, which was in 2015.
Man, we're old.
And sorry?
Man, I said, man, we're getting old.
And I think, if something works, fine. But the problem with ICT that I always have is that he has lots of conspiratorial views, such as he thinks that there's, or at least he tells people that there's an algorithm that the central bank has made that delivers the price, that creates the price all day, and that you just need to know what this algorithm's doing because it's set by the central bank. Now, you and I know that's complete nonsense.
Right.
But to the newbie, they don't understand that, the FX market, for example, is all OTC, that it's all quote driven, effectively, and that it's just dealers that are basically providing two-sided quotes all day. You either take the quote or you don't, and that's what gets fed through to liquidity provider, to broker, and that's how you receive your price in MT4, MT5, whatever platform you're using. And it's these kooky conspiratorial sort of views that I don't like, because it feeds into things like, oh yeah, market makers are, controlling the market, they're ruining your life. Well, really, I know a bunch of market makers. They're just normal people from, like, in the UK, Essex, who barely have a qualification and who are just quoting all day. They're fantastic at what they do. They're great traders, but they're not like this shady cabal of people who are looking to hunt your stops. Like, it just doesn't work like that.
Especially on the demo account. I saw him one time post on that. Like, he's like, they're hunting my stops, and somebody pointed out, but you're on a prop demo account. Like, they're not looking for your stops there, buddy.
But this is it. It's like it kind of removes accountability. It's like any kind of religious or, I guess, cult-like belief. I'm not saying religion's a cult or anything like that, but there's an essence of removal of accountability on stuff that you're not really sure on, because it makes you feel a bit better when you can't really risk in your own money, right? So I think it's more a case of try and get accountable a little bit more, rather than believing in kooky beliefs, and just look at the data, look at the stats, find out how things actually work. Delve a little bit deeper into who the participants are in the market, and understand your counterparty, basically.
I'm curious, do you think it's beneficial for people, new traders, to start like a demo trading account to go and do your back testing or your forward testing before you dive in and do a funded account? Or self-funded? I know funded account's sort of a bastardized term now because people relate it to prop. Before anybody puts any money into an account.
Yeah. So I think it's good to learn the platform. Use demo just to understand the platform. But it's a tricky one, because the second that you start encountering slippage and stuff like that, things change. You and I both know the amount of people who say, I entered at this price, but I actually got it 3-4 pips higher, or ticks higher, or what's going on. And because they're trading on such small time frames and day trading, it's taken, like, if you've got an entry that your strategy is tested on, where your average entry, and this is on demo, your entry, because you get executed instantly on demo, there's no slippage issues. If you've got a strategy whereby your average exit or your average profit take is 15 ticks away, but that's on demo. What's going to happen is the second you go live and you start getting slippage issues where your average entry is then maybe 2-3 ticks away from your demo tested entry, you're then losing maybe 10 to 15% of what your expected value is. That can be enough to actually ruin your strategy. And so this is why I'm saying, like, fine, look at something if it's over a long term where 2 ticks doesn't really matter if you lose that. So if you're swing trading, position trading, you're not going to care. If you're day trading, then that really, really matters, because that's really eating into your expectancy, basically. So I think the one thing that I would suggest is when you're testing a strategy, actually test it on these funded accounts, the actual prop accounts, because I think that's the ultimate use for it. Because number one, you've actually got risk on the table where you're doing things properly. You don't want to blow up the account, but you also don't care because it's fixed. You might buy an account for $200-$300. So there's still some form of psychological risk, but you're not taking dynamic risk whereby you can actually get a margin call and you can lose all your money, basically.
Yeah, I mean, that was the whole reason why we put part of the reason why we put the challenges inside of BullRush, where we don't do funded accounts. We're not that style, but you can go and spend $5 on a challenge just so you have some money at risk, and you can go test strategies and just see, are you a good trader relatively low? And we've had a lot of people do that. They come in, they'll buy one of these challenges, they'll pass, like, okay, I'm good. Then they'll go to either a self-funded account or they'll go to a prop firm and then really go and scale up from there, because we don't do large sizes like what those firms do. I know some prop firms, it's like $5,000, $10,000 to go purchase one these days. We don't have that concept. That's ours, like $5, $10 just to go for, like what you said, put a little money on the line and really go test it.
Yeah, great place.
Yeah, I think the regulation is going to clamp down on it soon.
You think so?
I really think it's going to clamp down this
on the prop side.
Well, the reason why is because really to do with the reporting, because all of them have a broker, but are the trades being reported? And if they're not, then that's breaking regulations somewhere. And that's the issue that I think, because the risk has to lie somewhere. It can't not, effectively. And the risk at the end of the day is probably lying to some extent with the broker and also the prop firm as well, because they're a lot of the time just a bit of a marketing.
Well, I know most don't even run a brokerage firm anymore. Like now that MT4 and MT5 sort of went away from the space, I know most of them are just the prop firms just go, okay, I'm going to go to MathTrader or one of these other platform providers, and it's just them, and then everything's on a virtual or demo account, and so nothing's actually hitting a real market.
And then that raises the question, are you just running a B book?
Well, they are 100%.
Exactly. So then it's like, all right, so then there's the regulatory part even, which then basically says, okay, well, you're a broker dealer because you're taking on the risk. So it's very interesting how the model could shift. But I think it's a really interesting part of the industry. I've personally never traded on a funded account like that. But I know plenty of people that have, and some of them do it really, really well. They can do really well out of it. I think they know the game as well. There's a certain game to play. I don't think it's true trading. I think they understand exactly what they're playing, which actually is more of a volatility game, I think. And so it's interesting. I've got a bit of a strategy that I think can win against funded firms. But it's really deriving stuff from options and making sure that you're well within the risk limits, just so you can keep it ticking.
Yeah, no, that makes sense. Davin, I apologize. I'm commandeering all of this. What questions do you have?
No, I mean, I do see a question here on Twitch, actually, our first question on Twitch, and it's for you, David. What's the biggest trading risk that you've taken, I guess, in your past that turned out to be profitable? So if there's one, maybe trade that stands out, or maybe one event.
Probably, it was probably this year, to be honest, on crypto. Like, I threw a hell of a lot into this coin that was based off of a footballer leading into the Euro championships, and it ran up a hell of a lot. Like, it ran up to like 100 150, 160 grand off of a couple of grand, which was probably, it wasn't risk in the sense that, oh shit, I had a load of money on it. It was more a risk of, well, there's literally nothing backing this
Yeah.
apart from a cartoon of a footballer.
Yeah.
And so that was probably the risk. Like,
one of the meme coins, as they say.
Yeah. I'm in some absolute crap. It's brilliant.
Oh yeah,
I'm not going to name any.
I've gotten my hands dirty with some of those as well. I won't. Yeah, we're not going to name any here to get anybody into holes.
Yeah, no, they're good fun though.
Yeah. Oh yeah, those are a lot of fun. That's I look at that as like going to the casino. Well, every time I put some money into one of those.
That's exactly what it is, and that's what people should treat it as. You know, I think a lot of people treat it as something that's way, way more serious than that. When actually, I don't think I've ever made 10x quicker on anything else than putting like $200 into, or like a soul and a half or something, into it. Just, you know, it will come off or it's not. And if you lose, it's not that bad, but you got the upside of making a ton. It is a casino at the end of the day.
Yeah, I agree. I've never made 10x faster than on some meme coins that I've invested to, but I also haven't lost 100% of my wallet faster than some of these meme coins that I've invested in. So, you know, it's
very true. I wouldn't even say invest. I wouldn't.
Yeah. Sorry, invest that I've put my money into.
Yeah, it's very, very prudent investment. We've gone through lots of rounds of investment committees to dive into PP coin.
Yeah. Andrew Tate coin, since we were talking about him.
Yeah.
Funny.
I think there's another one on YouTube here.
He says, we see, where does David see Bitcoin heading? So what do you see for the future of Bitcoin?
Shall I screen share?
Yeah, I can pull up your screen here.
Let me. Do I have to hit screen share just here?
Yep. Just share your screen and then it'll pop up. Yep.
So, Mr. Bitcoin, I've said that we really have to start motoring with rate cuts. So, my view is that we stay within this sort of range until the end of the year. This is lovely here, though. This is really, really nice. That whole little dip here. Like, that'd be something that you'd want to see for a break above here. But what I still think happens is that November comes and we only get 25 basis points, which is fine. But we've got to look towards Q1 for the real breakout.
Oh, oop! I think we might have lost him there.
Am I still here?
Oh,
yep,
you're back
I
now.
don't know what.
Oh, sorry.
Let me share your screen here. For some reason, you popped up. Yep, we're all back.
All back?
Yep. Back.
So where did I finish?
You ended at the where you're just starting to talk about the break point.
Oh, okay, yeah. So the break point will literally be for me. We're getting into rate cuts, but then we're not seeing any real issues with employment. We're not seeing any issues with US growth. One risk is that we did see inflation expectations tick up to 3%. It was expected at 2.9%. Very, very minor. So it could be a rounding error. But the only risk to there is that inflation sort of ruins the party a little bit. I don't think it does, though, personally. If we were to remove, I always forget how to hide on TradingView. So this. So I like to do this sometimes with moving averages and just the price and look at where the moving average is. If we just focus on the longer term ones, so we've got the 100, the 50, and the 200. We can shove in the 20 there as well. This is sometimes how I like to just put the charts down, because then I'm just ignoring complete noise. And then we've got the 200 week here, which obviously no one wants it to dip down here. But if it did, it wouldn't be the worst thing, because then you're not going to see it again for a relatively long time. But you can see where the trajectory is, you know. You can see that I think once we've broken through this bit, you just put that back for a sec. Once we've broken through here, I think 100K is in sight for In my view, Q1 of next year, the end of Q1, maybe we'll see it in late Feb, March. But until then, I think we just stick here. We probably peak above here, might even get up to 80, but then we tick back here. But Q1, I think, yeah, we'll be at 100K next year.
Nice.
Can we just go back? You mentioned the dip down there and the back up, and that was an interesting part for you. Why specifically is that so interesting?
So I tend to think of things as, okay, I'll show you exactly why. So I tend to think of things from a perspective that I think I mentioned it, the bell curve. So if we go here and I go price there, we've effectively traded down to here and the market hated being back down there. Okay. And so for me, it's also hated being down here. But what it's looking at is here's the point of control. Here's where most of the activity is happening. It looks like all of the activity wants to be in this upper half. It doesn't like being down here. And it tried it again. It hated it, sprung up. So for me, what it's indicating is higher prices, which makes sense because rates are being cut, right? Bitcoin's very, very negatively correlated to interest rates. Higher the rate, lower it goes, with caveats, of course. You know, we're seeing massive corporate growth, massive corporate earnings. Usually when rates go up, things are constrained. We haven't seen that happen. So Bitcoin has had this rally through early part of 2024, ETF, blah, blah, blah. But this is sort of something that's a bit of a spring to me. You could almost think of it as an inverse head and shoulders, but not really. There wasn't much volume that wanted to really do anything here. Buyers just stepped in and it just sprang back up. So this is why I always think looking at things from a statistical bell curve, where does price actually want to be kind of perspective, is kind of a good mental model. You don't need to have that there, but you just need to think of it in those terms. Price hated being here. So why would it want to be back down there anytime soon?
Okay, that makes sense.
Nice. Yeah, to the moon.
You like that?
So whenever you see, or whenever I see moving averages converge like this, it tends to mean that, you know, if you even think of the VIX, for example, if we go and have a little view of the VIX, you see that whenever the VIX comes and gets naturally very, very tight, there's going to be an explosion in volatility. You know, those shorts get massively unwound. It's kind of the same concept when you're looking at the moving averages come together, is that something has to cause price to move either way. Now, in an asset like Bitcoin, where predominantly it's well supported because people are, you know, buying a lot of the time, there's a fixed supply as well, there's always going to be a bit of an upward drift. So really the edge in Bitcoin is to be long, unleveraged. There's more edge in being tactically short at certain times, but the edge in Bitcoin is always just to be long unleveraged, in my view. And I think that's why there's some correlation with the S&P 500 in that Bitcoin has greater returns on a risk-adjusted basis than the S&P 500 over the last, 10 or so years. But they still have the same sort of attributes.
Outside of just, you know, punting on a football or a meme coin, do you trade any other cryptos outside of Bitcoin?
Well, yeah, just the meme coins, really. I don't really look at anything else.
No Solana?
The meme coins are, you know, it's so cheap to trade a Solana coin, which has its ups and has its insane, which is a good and a bad thing. Back in August, it was awful for you know, Solana pump funds. Like, it was just insane. But really, Ethereum, no. I thought Ethereum would perform a little bit better. It's not too sure why. But I think, look, whenever you're thinking of something sort of thematically like this, there's more of a story and narrative, almost like a romance with Bitcoin. Satoshi still isn't found. They don't know who he is. That goes a long way to having a bit of a legacy behind something. Obviously, it was the first crypto as well. That's why I think Bitcoin will always continue to outperform, purely because it's got that natural it's got a story. We're human. We love stories. We understand the world through stories, and the same comes to assets. There's only so much of a story that you can tell with technical analysis, for example, which is why I've got sort of quant models. I've got filters that are based on loads and loads of different technical and quant aspects, but no one gives a shit because no one cares about that. They care about the story behind a stock or an asset really deep down.
Speaking of the story,
And that's again is absolutely why Bitcoin is.
Oh, sorry. I was going to say, speaking of the story, I know Davin mentioned it last week, but didn't they release some Netflix documentary?
Yeah,
on
it was the
the person?
HBO. It was an HBO documentary. Did you happen to see that? Or I honestly haven't watched the whole thing. Yeah, I fall asleep. I have a problem falling asleep at night as soon as I start watching something. But yeah, they allegedly the documentary
But
released who Satoshi was, and it was one of the early developers. I can't remember his name. I'm gonna look it up right now. Believe it was
Aaron said it wasn't him though, like
yeah.
straight after.
Yeah, he said it, right? He said it wasn't him. But I mean, if someone exposed me as Satoshi, I would say that's not me too, because doesn't he hold like a couple $1 billion
Yeah,
worth of Bitcoin? So you wouldn't want the world to know that you hold billions of dollars worth of Bitcoin, and two that you are the creator of Bitcoin.
yeah. No, I guess so. I think I think that for someone so smart
Peter
though, I
Todd
reckon
was
he
his
would have put
name.
way more. Yeah, I mean, I don't know. I always thought it was that Hal Finney guy, but lots of people have told me I'm wrong and abused me for thinking it was him. So I've stopped thinking it was him.
Hey,
I feel like that's what the crypto community does. Like if you don't go with their belief set, you just get thrown under the bus real
Yeah,
quick.
I think I
look,
think it's a conglomerate of
last
people.
year,
I don't think it's one person.
yeah. Well, did you hear about that? The recent story was it Michael Anderson, isn't it? Right. Basically, he sent $50,000 Anderson to say that he wanted to launch a coin.
Mhm.
Anderson sent $50,000 to this wallet. This AI spoke to another AI to launch a coin, and the coin ran up to $150 million in
Oh my
market cap.
gosh.
So, talking about conglomerates, maybe it was, an AI that started it. I don't know.
Yeah,
Maybe it's all the FBI and CIA. Who knows?
that's
But
crazy.
I just
That's
thought that was the
crazy. One of the older models of ChatGPT that turned on ChatGPT 1.0, and then 1.0 and 2.0 were talking to each other and learning, and I guess they were evolving themselves and becoming smarter, and I think like either 1.0 or 2.0 became like as good or comparable to like the new 4.0 now. their own will. It's crazy.
I
So
kind of
I wouldn't be surprised if they
I kind
create
of
a
like
coin.
it. Like it kind of it, I can't wait for the day where I can just feel unburdened because AI is just going to eventually take away everything from me, and then I just don't have to worry anymore.
Yeah, we'll just be AI. We'll just be AI engineers. Everybody's gonna become an AI engineer. We'll all have to just,
Yeah,
learn how to talk to AI to get it to do what we want.
yeah,
Yeah.
yeah.
I
We're
just
just
looked it up too.
breathed by
66
AI. Pretty
billion is
brilliant.
what 66 billion is what Satoshi currently allegedly holds in Bitcoin. So yeah, if I was Satoshi, if I was that Peter guy, I definitely would not say that's me. Would not agree.
Yeah, no, I think you're right there.
Yeah. All right. Well, it's been a really great conversation. We're coming up here on our time here. We went a little bit over time too, but I know I had fun. I learned a lot from you guys, and I hope everybody listening did as well. Is there anything else that you wanted to say before we go here, David?
Just that probably the best advice that you can take away is to be long the S&P 500 in a tax efficient wrapper in perpetuity. Don't worry about any stocks below $10 billion and just never be short, basically.
That would be short.
And if people wanted to follow you online, what are your social media handles?
I'll make sure I add it in the description.
Finkmoney underscore. Yeah, Finkmoney underscore, and then think.money is our website. So you can sign up for the weekly free newsletter, comes out every Friday.
Nice.
Great.